trading to be done, no doubt. The end of this week is going to be really important, more so than what's happened during it, but we'll get to that in a moment. Let's crack on through all the news and views and comments and central banks and all the rest of it, and then we'll have a look at markets and see where we're at with those. Starting with the Bank of Japan, and one of the contenders for the hot seat, Hiroshi Nakasawa, is apparently not going to be in the running because he's just taken up a post at the APEC Advisory Council. I don't know if it rules him out entirely, but taking a new role when you might be in the running for head of the Bank of Japan doesn't seem like he's considering it himself. But that's one of the runners possibly out of the race. If you're in our chat room, you can go to the newsroom where Kay put up a handy guide of those who are in the running. I think it was early this week, so you can check out all the runners and riders in that. Kuroda was in Parliament yesterday, and he said that the paper loss from bond holdings at the end of DEC was 8.8 trillion yen. Note that's the paper loss, i.e. the accounting numbers, rather than actual losses there. Of course, the BOJ can run big losses on their holdings, paper losses, but it all depends on whether they decide to sell up their holdings as to whether they realise those losses. If they wanted to, they could just let them roll off and they get their money back on the bonds that they've got, and probably bar a few broker commissions, they'll be largely flat on the position. Coming over to the SMB, and our mate Jordan said that 2023 GDP in Switzerland to be above zero if we are lucky. Who thinks they may be lucky? He said inflationary pressure is stronger than the SMB can tolerate and can't exclude more interest rate increases. The tone on or the rhetoric on further rate increases is something that's not disappeared from their language. But maybe that first part of that comment, that inflationary pressure is stronger than the S&P can tolerate, maybe hints at potential change at their meeting, which is coming up the 23rd of March. So next month they have their meetings quarterly. Over in the Eurozone, we had a ton more PMIs coming out. We had it coming out all over, actually. In Japan, as we've seen, further divergence between the manufacturing and services. Services coming in round about as expected, but confirming up on last month. Into Europe, and let's just stick to the PMIs because I can't be bothered to look at all the other little bits and pieces. France, a little bit better than expected, only by 2 pips, still down on last month, so in contraction. Germany as well, moving a bit higher, beating expectations and moving into expansion there, or a bit further into expansion from the flash number that we got prior. The pan-Eurozone number also up a bit on the flash number. UK as well, a bit better on the final read, but still showing the miss on last month. Now, what I've looked at in the details when doing these numbers, and as you see, China there as well, I missed that, also an improvement. I looked through all the details of these PMI reports, and the main theme, particularly from the Eurozone, and it's important for inflation, is that input costs are coming down, or lowering. The scale of price rises is coming down. However, a lot of these surveys for the Eurozone noted that output prices, i.e. the prices firms are charging customers, are at, in some cases, survey record highs. So although we hear about the theme of inflation coming down, there are still elements within the different sectors of the economy that are showing that price rises are still happening, and happening significantly, which may put the brakes on some of these inflation falls that we have been seeing. The likes of Spain, where inflation actually rose, the likes of France, where it didn't come down perhaps as much as expected, so on and so forth. So it's not the fact that we are potentially going to see a straight line down in inflation. There may be times when it ticks up a bit or stabilizes or doesn't go down anymore. It's not going to be a straight line. I think monitoring these sort of numbers is very important to gauge that. In Japan, the report there was slightly different. They were showing that there's still high input costs, but that output costs are lagging behind. So they're a bit slower in catching up. So in terms of margin, you know, the difference between what you buy stuff at and what you sell stuff at, there's a little bit of a squeeze coming in there. In China, and that PMI, the data says that prices are largely flat, or the difference between input and output prices are largely flat. Prices are rising moderately and output prices are lagging a bit behind that. So no real big inflation pressures coming into China, and that's something we need to keep an eye on as the big reopening takes shape over the weeks and months ahead. Any thoughts on any of that stuff, the Japan stuff, before we move on to the central banks?
Yeah, first of all, in Japan, it is known that companies are very, very slow to pass on higher prices, just because the wages have been so slow. So perhaps we'll see, and that's a bit of a thought going into those wage negotiations. Perhaps we'll see after the wage negotiations, if we get those bumper hikes that some companies are promising, that all of a sudden we see those output prices catch up in Japan. That's the thought that I had seeing those numbers.
Yeah.
And the rest, if you look at the overall data, as we've been saying already a couple of times on this show, we are heading into well, I mean, it's the how it looks now, the data look now, that we are really heading into a soft landing, right?
Yeah.
So we have to adapt the way we perhaps we look at the markets a little bit. But yeah, the thought on Japan is that one, and the thought on the rest is, although China numbers, we always need to take them with a little pinch of salt, to say the least. But if you look at those numbers, there's not a lot of red in there, right? It's there's a lot of green in there, and even if you look at some of the peripheral data, who usually are a bit, how shall I say, more fragile than the core of Europe, they are showing decent, or let's say at least half decent numbers, even in contraction still in France. And Germany on the composite just, but we can hardly call them lousy data, right?
Yeah, yeah, no, very much.
I think that's what we've been monitoring here and talking about very often, because you first of all of us started to show the cracks in the housing market. But then we have been monitoring all those data, and we have been forced to say that apart from some, I wouldn't say outlier or also numbers, and the situation can still get worse, but we have to say that where we expected all the numbers to really turn south, our expectations were perhaps a little bit too sour for all the data that we are seeing come out right now.
Yeah. No, absolutely. It's almost like it's a feather falling to the ground rather than a cannonball.
Yeah. You don't. We are not destroying economies here.
Yeah, exactly. And I think that's going to be the theme going throughout the year. You know, we're not going to see boom times and we're not going to see bust times. We're probably going to float around, you know, comfortably in the middle of, you know, maybe, you know, -2 to +2 GDP growth throughout the year. You know, in that sort of range. But I still think that there's still a bit of risk, particularly for the US, that rate hikes haven't fully taken a bite yet. You know, they have come out really fast, and I can't see how that happens without seeing some pain. But, you know, as Kay's just saying, the signals at the moment are pointing to a softish landing rather than a crash landing. And if that's the case, then that's what the market will trade.
And I reckon that's also one of the reasons why after setbacks. We are seeing those equity markets come back roaring higher and being. We were calling them complacent for a very long time, but the market is the market, and the market is bigger than any of us will ever be. Hopefully, you guys are having huge accounts, but we will never be able to compete with the guys who are handling trillions of dollars, like the BlackRocks and stuff. And they have to put their money to work. And if they are seeing signals for a soft landing, we will see assets holding up pretty well. And that is the way we are, and we have to look at markets, and that's why we look a lot at fundamentals here. Is at least if you see something holding up and you don't understand why, look at the data, look at the fundamentals, and all of a sudden the picture becomes less cloudy. But of course, as you say, we need to watch that big domino, for which we will have probably a good indication today, especially with the revisions of 2022, perhaps, that labor market is going ultimately, I reckon, to tell us whether the economy stands or falls, right?
Yeah, exactly. You know, you say about as whether things look cloudy or smoky or not. You know, I always, just to have a quick look, I always is a bit of a surprising one, because it's, you know, even just on the China aspect, I would have thought it might have retained a bit more of a bid than it has. I mean, all right, we're knocking around an $8 range, which is nothing for oil. But you know, if even with the soft landing thoughts, you know, that should be supportive of oil and commodities, because if we're not going to crash and burn, that means that demand is going to be there, albeit at maybe lower levels, but it's still demand. And you know, I'm just wondering why oil isn't keeping its bid. You know, I'm not expecting it to rocket up to $100 or anything, but you know, maybe go in the 80-90 zone rather than this 70-80 zone we've been floating around in. So I think there's still pieces of the puzzle that are still not 100% clear. And we just have to see how those develop, I think.
Yeah, and look at the setback that we had in metals yesterday afternoon. That also, if you look at good economies, and then gold is a lot more speculative, I think. Well, silver lately as well. Silver, if you talk about an economy that holds up, should be holding up as well, because silver is an industrial metal and needed to produce whatever the modern world is producing now. So that as well is telling us that the market is not completely on a mega train yet. And we're in this probably gray zone. And you're right about oil. But then against that, we have OPEC, which is trying to keep things high, but also not managing to keep those prices high. It's a bit of a strange one. And we also can't forget that if you look at energy, like oil, electricity, gas, let's not forget that Europe, for instance, has been loading up their reserves at monster high prices, and they probably, the reserves are relatively full, as we've seen in past weeks. There was also oil tankers waiting on sea to offload, so the reserves are pretty full, and all those things that they take time to smoothen out, right? And as you rightfully say, I don't think there's still a part in the market which is in doubt, and we are in this zone right now, where we or where the market has to decide, or decide soon, if it will be roses or crap, you know. And but in the meantime, some assets are holding up very well because money has to be put to work.
Yeah, exactly. Right, well, let's get stuck into the first of the central bank reviews, the Bank of England, and as per usual, a real mess from Bailey and Co. One of the key lines was that the MPC says it will no longer, or it says it will no longer say that it will respond forcefully on rates. or that further increases in the bank rate may be required. So they did the hike 50 pips, but removed language about acting forcefully in future or whether they will act again at all. They mentioned that if there were to be evidence of more persistent pressures, then further tightening monetary policy would be required. Bailey,
hello, chaps. I'm here. Sorry to interrupt. I'm here.
Right.
Hello. Yeah, good.
Cool. Bailey was out saying that he is seeing the first signs that inflation has turned the corner. Then said that inflation may not fall as forecast and that we are in uncharted territory with inflation above 10%. And then said inflation risks are more skewed to the upside than at any time in the MPC's history. And it's too early to declare victory just yet. Inflation pressures are still there. BOE's Broadbent said that it's not clear that the next rate move might be in either direction. And then this morning, Bailey was out doing the press round saying it's too soon to say if this is the last rate rise. So it was my immediate reaction yesterday that the BOE are saying that they could well stop hikes, but there's still lots of risks to say why they won't stop hikes. And I'm not clear either way what they're going to do, these clowns. I don't know if they're going to hike again or not hike again, hike more than what they need to hike again. It's the usual shit show, to be honest with you. At the moment, we're pricing in for the March meeting a 59.1% chance of a 25 pip hike, with unchanged the balance of that. Boys, what do you make of the Bank of England? You got clear, defined definitions of what they're doing next?
Of course, everything's crystal clear. We're doing no, of course not. Come on. We get the usual thing. We talked about this so many times with the BOE and Bailey. Every opportunity they get to throw a dovish curveball, they will, and they always want to keep their options open. The bottom line is that the inflation is high. They know it. And it's not dropping at the same pace as the US, for example. So that's the issue they have, and the Eurozone to a similar extent, that they theoretically should be hiking a lot more to bring inflation down. But, with the Fed slowing down and with effects of tightening starting to show, they don't want to destroy the economy in the process. So it's a very difficult situation. I don't know what I would do in their place. Actually, no, I do. I would have started a lot earlier and done it a little bit more softly, let's say, instead of doing, 50 and 75. No, actually, no, they didn't do 75, did they?
No.
It was the Fed who did 75. But yeah, it's a tough situation. And I think, unfortunately, the central bankers and Bank of England in particular are always going to err on the side of caution. So they're going to...
These lot have taken fence sitting to a new level, haven't they?
They've taken what, sorry? Fence sitting to a new level. Yeah, of course. Of course. And so I think they're going to take err on the side of caution, which means they're going to slow down and halt sooner than they should, because they're going to be a little bit afraid of what the effects of a collapsing economy will have on, should I say, political cost? Yeah, political cost. So, that's what they've done for the last 2 decades. Every opportunity they get, they are on the dovish side. So I think that's going to continue. And also, if the Fed stops, which now it looks like we are, as Powell said, a couple more hikes and we're done, I don't see the other two, the ECB and the Bank of England going full guns, all guns blazing while the Fed is stopped. So I think we're getting close on that one too. And I'm actually writing a blog post on all this as we speak. I'm going to have it posted within the next hour or two.
Good stuff. Okay, I could probably always run what you're going to say about the POE.
If I would, me, when Bailey speaks, pound usually goes down, and it wasn't any otherwise yesterday. If I, as I said, if I would comment, and I did in the chat rooms yesterday, there's only 2 words really that represent what the Fed, ECB, and BOE have done, and that is data dependent. They're just going data dependent. If anything, Powell was probably the more precise about how many hikes they will have to do. Although, as we've already talked about, they've all gone. They also gone into a little more cautious mode, which is relatively normal. We are a quarter or if not 0.5% away from their target zone. So I'd say it is a bit normal, but Lagarde yesterday was never clear about how many rate hikes they should do. Apparently 50 is baked in for March, but then after that we don't know. And then Bailey was even more how shall I say, I don't know what I have to do mode. So they're all in data dependent territory right now, and for me personally, that's it. That is what I took out of all the major central bank meetings.
Yeah, cool. Michael, I see your question on the rhetoric potentially changing to growth. I'll touch on that once we just got through all the new stuff here, because that is something I want to speak about today. So we will move on to the ECB. And again, just picking out the things that struck me, her first words out at the presser were quite strong. The ECB will stay the course in raising rates significantly, and we intend to raise by another 50 basis points in March. That was right off the bat and delivered with quite a strong tone. So she wanted to get that out and across above everything else. Then she said, after March, we will evaluate what to do next, and that we won't be at peak level in March. She's saying they're seeing strong price pressures and inflation risk, but then says inflation risk can become more balanced, and wouldn't say that this inflationary process is already at play. Now, keep an eye on that word disinflationary. It's going to be the new buzzword for central banks. Powell already dropped it. Lagarde's already dropped it. You're going to be hearing that word probably every 5 minutes from now going forward. They won't want to indicate anything less than that or more than that. Anything, they won't say it's deflationary, anything like that. It's disinflationary, the falling inflation. So that's going to be the buzzword going forward. Now, what did we get from the ECB? Well, she promised us 350s, and now it's more looking like we're going to get 250s and something else at the end. And that's really what did for the euro yesterday, which, you know, took a bit of a beating over the ECB. It's come back a bit now, but, you know, it did have a decent move down. Let's get into a shorter time frame chart there. As I say, it's had a bounce this morning, but, you know, a lot of this over the ECB was the fact that maybe we're not getting 350s. And, you know, we got the usual sources pieces after, saying that they see at least 2 more hikes, and maybe hikes of 25 or 50 basis points in May. Now we're talking about May. I also see a terminal rate of 3.5%, these ECB sources. Now the rate's currently at 2.5%, so that means we get another 100 pips of hikes. So that puts it in the 50 and 50 camp potentially. However, the market pricing today, we're pricing a 53.2% chance of a 25 pip hike. So pricing is actually leaning towards a 25 for March more than a 50. And the 50 is the balance at a 46.8% chance. So there is a bit of disparity in the market at the moment as to whether we're getting a 50 next month. I think a 50 is nailed on. But what I think has happened is that, and again, highlighted this in the last couple of weeks, that we had literally every ECB member out talking their case before this week, before the blackout. There was all but 6 members. I think there's 26, 27 now. All but 6 came out talking about it. So I think there's a bit more of a bum fight with Lagarde over, particularly from the Doves, over whether 350s is appropriate or whether 50 and another 50 and something else afterwards. But either way, they remain on the hike path, and the euro's picked up a bit this morning. Looking at everything as a whole, And obviously, we've had every central banker from the ECB rolling out the gates this morning. F.A.C.E said rates to rise 50 in March to stay restrictive. Simkus rate hikes. March rate hike may not be the last half-point move. Casimir, March hike will not be the last. And it won't bring us to the peak. So they're all coming out the floodgates as always after these meetings. So taking everything as a whole today and talking about what Kay mentioned as well, we are entering a bit of a grey area in terms of pricing expectations for what's moving forward. I'll take dollar yen as a case in point where you can clearly see how expectations work in markets. Okay, so dollar yen, huge move all the way from 2021. This move was a lot about the Bank of Japan doing nothing, a lot about inflation picking up in the US, across the world, the central bank, the Fed turning hawkish. It was around here, late in the year, where the pivoters started pushing and we still hadn't finished making the highs. The Fed was getting more hawkish still, but the pivoters had already started trying to fade the Fed. Okay, now we got up here. The Fed got to peak hawk, if you like. Not even that. That was in December we got to peak hawk, but they were still there. The market was already moving ahead. Of course, we had Bank of Japan intervention and the like, but the pivoters gained ground, and that's been a lot of why we've had this move back down on the dollar side. At least, the Fed's got as hawkish as it's going to get. The market's seeing the data turn soft. The pivoters are gaining more and more traction. They're selling the dollar. Yields are coming down. Obviously, in there as well with some of this BOJ expectation for changing policy. Okay, but if you want a clearer chart of how expectations get priced and get traded in the market, dollar yen is the perfect chart to show that. So here we are now. We've priced the Fed hawkishness. We've priced a bit of the pivot. The market hasn't gone any lower than 127. It's saying, right, enough's enough. We've just come through all the big central banks again. We know what the ECB is doing. We know what the Bank of England's doing. We know what the Fed's doing. The whole global hike cycle is potentially coming to an end, or at least a pause. So the market is now, what's next? What do we trade next? Well, what are they going to trade next? They're going to trade the pivot. They're going to trade when rates coming down, and they're already trying to do that. We know some central banks are already having their prices for year end already being priced for some rate cuts. That's what the market's going to be trading from here. But we are in a bit of a grey zone because the dollar's not going up, the dollar's not going down. It is still moving against the other pairs, but we're not really massively smashing out of ranges. And so that's going to be reliant on the data that's going to come over these next few months. The market is then really going to get its teeth into this pivot and rate cuts. And we're either going to get them at the end of the year or we're not. And the data is going to tell us that. So until then, I don't think we're going to see any big, massive trends developing until we get a clearer handle on this year's data, how it starts. So I expect ranges to stay in play for these central banks going forward. What do you guys think? I mean, you said it, Kay, so, you've highlighted a bit of a grey zone still. Do you see anything that kicks us or starts any big trends coming right now?
Sorry, can you hear me? My internet connection went down. Okay. Do I see any big trends? And then everything stopped. So can you repeat the question?
Yeah, can you see any big trends coming? We're talking about whether markets at the moment are happily where they're pricing. They're waiting for the next move, which is likely to be rate cuts, and the data is going to tell us when that's going to really start getting priced.
For the very short term, so for the next, say, month or two, I don't see what's going to destabilize, let's say, what's being priced in. So cuts priced into the Fed by year end, I think that's a little bit aggressive. But in the short term, I don't see why the market's going to reprice that. We're still expecting a drop in the US CPI in February, and I think, as I said before, I think it's going to be bigger than expected, and that's going to give dollar bears and risk bulls something to cheer about. But I need to see a lot more evidence for me to say yes, the Fed are going to turn around and cut, and because we have to remember there are second round effects. As wage growth has been growing, yes, has been going at a decent pace. Of course, not matching up to inflation, but it has been growing. You're going to get more spending coming through unless the markets completely implode. So my view is, I think pricing cuts for the year end is, I'm not convinced about that yet, but for the next, let's say, month or two, I don't see what's going to drive the market to go and reprice that, because it's far enough in the future that the market shouldn't really care yet about that. But yeah, I mean, to answer your question, I think, unfortunately, I think we're going to be kind of ranging for the next couple of weeks, at least until the CPI, the US CPI comes through. And because the market's already done a lot of work, we've priced in a lot of stuff already. Do I think that the Fed's going to pause and then start hiking again? I think that's possible. I think it's a low probability scenario, but I think I could argue it's more probable than them slowing down to zero, to basically stopping the hikes and then cutting. So again, this is something that's far enough in the future that it's enough for me to say I don't know. I don't know what's going to happen. But I think for the next few weeks, we're going to be ranging. So we go back to jobbing in and out of our positions. For those who have been following what I've been doing with silver, remember, on the Fed day, I got long at 23.50 for my second half. It went up, tested 24.50, and then came back down. So yesterday, I wrote in the chat, I got out at 23.50 for nothing on that trade. I still have my other half long from 20.50, which is good. But again, we go back to the same range now, and I'm not convinced. So unfortunately, no breakouts either way. Yes, stocks are trying to rally and are rallying, but again, it's not a massive breakout in any fashion. So unfortunately, I think we're back in range trading. So trade in and out of your positions, be nimble. Don't be afraid to say, yes, I was wrong. So this last long I took with silver, yes, I got out at flat, but at the end of the day, I was wrong about that. So, cut that and reconsider.
Yeah, no, exactly. And I've done exactly the same thing this morning. As you boys and girls may know, I've been long Aussie dollar since October, all the way down here at various levels. And just this morning, just weighing everything up, having slept on the central banks this week and the data and everything. And I've decided to half my position, pretty much half my long-term position, because this has been a strong run. It's been one way. And the signals are telling me that, maybe we're near the end of this type of move. The market is getting settled. It's getting priced. And as I say, this has gone one way, and markets don't go one way forever without decent pullbacks, or even if it's to refresh the trend. So I've cut half my position on here. I'd rather stick it in the bank than keep it on the table for now. I've still got, obviously, the other half to play with. But I'm just beginning to feel like things are getting a bit toppy in terms of pairs versus the dollar. And the levels are telling me that we're not cracking above these levels after a few attempts. We are hitting some of these bigger levels now. We can't get above this 71 and hold above it. So there's just signals that are telling me we may be at least a decent pause point. It could be consolidation as opposed to just a pull back. But anyway, I'd rather manage my money and stick it in my bank than, as I say, leave it on the table. Which sort of brings us over to Michael's question about the ISM today. Is it going to be more important than NFP? The data on the whole is going to be important. We know the NFP is a big number. We know it's a big data point. You've got the wages components in there. You've got the unemployment component, the participation rate component in there. So, it's all going to make up the picture. I still think there's a big risk that we've got the weather component in there today as well. We've seen that already this week. But then other evidence, Challenger grey layoffs came in at 103,000 versus 44,000 prior, a jump of over 400%. And that's reflective of all these job layoffs that we've heard about, Amazon cutting this, others cutting here and there. They're all adding up now, and that 103K shows that perhaps things are picking up in terms of job losses. So it just increases the risk for the NFP. But in terms of the ISM, yes, it's going to be important. Again, look at the components, employment, prices, that sort of thing. But it's for the longer term picture, as Stel says. The market isn't going to sell dollar by 500 pips in each pair because of a crappy ISM. But you keep monitoring the data, you build up a picture of the fundamentals. And if the picture is showing trends in certain things, that's when you look for trades, because if the data is continually softening, and it's not just 1 month, it's 2 months, and in 3 months, and other parts are softening, like inflation, like we're seeing, that's when you start to think, right, well, I need to be positioned for this, because if it keeps going, or if it's showing signs of being a proper trend, that's when the market's going to move. That's when the market's going to get more bearish, more dovish. That's what brings the big trend moves. The same as it did for dollar yen, as I showed there. Those are the signals. So 1 month doesn't really make a difference, but you add them all together, and now it is starting to make a difference if it's showing you a clear trend. What do you make of the data to come today, Kay? Is it going to be? Is it going to flip everything on its head, or can it flip everything on its head?
It has the potential, and to be myself, I'm not going to say that one is much more important than the other one. Both will be important, and the importance to me lies in the fact that those numbers are coming out after major central bank meetings, and where the market is trying to figure out the picture. So both of them are going to really, in my opinion, be important. And the other reason is, and that is the most important for us traders, in my opinion, is coming out on a Friday afternoon after those central bank meetings. And the market could get extremely messy and jumpy this afternoon. So that only on itself is already enough for me to really think those numbers are important. Now, are they important going forward? I think the combination of the both are, because as I've already said, the labor market seems to be the last huge domino that hasn't fallen yet. But there's going to be those revisions. There's going to be, and we are after the central bank. So yes, this number is going to be scrutinized, and all the components of it, right? You have the NFP number. We will know how the unemployment rate evolves. We will have the hourly earnings. It's all the components are going to be important. And then, of course, I mean, the ISM is really something that the market and the big boys are looking at to trade and judge how the economy is looked upon by the companies themselves. So I'd say both are utmost important.
Yeah, no, I agree, mate. I agree.
And since we have, as usual, after NFP, a relatively slow data start of the week thereafter, of course we will hear from all the central banks speakers. I think I may turn my speakers off next week.
It's already started. Yeah, the Fed.
It's always horrible, especially when we've had several big meetings, one after the other. It's horrible. There's a lot of noise. But yeah, it can really set the tone for the next 10 days of trading until the next CPI drop out of the US on Valentine's Day. So yeah, I wouldn't say that the one is going to be more important than the other. It can get a real mess this afternoon if they come out in different directions.
Gavin raises a good point now. He's been highlighting Steen Jacobsen from Saxo, saying that the most important thing to watch this week going forward after everything is where the US 5-year closes tonight. I think that is valid. I've said it yesterday. I think that is valid for any asset, particularly FX. You know, where we close tonight could be very important moving forward. You know, for example, dollar yen, if we close within the range, if we don't get below 128, that's going to confirm, you know, the middling range we got here, maybe 131, 128. It certainly keeps us in the 127, 133, 134 range. If we're outside of those levels, I mean, I doubt we're going to see us above 133 or 131, but you know, if we've broken to the downside outside of 127 and we close somewhere down there, that potentially is going to open the door for a further move south. Same for something like euro dollar. You know, we've been messing around this zone for the last 2 weeks. Where we close is going to be important. Is it above 109? That's going to be a first step. Can it get above this 109.40 area that we've been highlighting for ages? That remains to be seen. You know, if it can't, then maybe, or if we're closing under 109, it's going to suggest we're going to stay in the ranges. But if we get a close above, that gives traders the impetus to continue that move. Then we start seeing support solidifying around these 109.40s, 109 areas. And then that gives you the next kicker. And then we might have another look at the highs and the move to 111 or whatever. So it is important to watch the closes. It's not definitive. If we close at 109.50, doesn't mean we're definitely going to 110 again or 111, but it pushes the balance of risks that way. If you understand what I'm saying, it gives the traders, I say, the impetus to say, right, let's crack on. We've moved away from this area. Let's see if we can keep the momentum going. Now, I don't trade closes per se, so I wouldn't automatically jump in if we close tonight at 109.50. A close is important for you guys in terms of trading?
For me, yes, because I'm not a day trader. Well, I didn't used to be a day trader. Yeah, Steve is also of the same opinion. I know he's said it so many times. So I always look at candles which are daily, and I look at the daily closes instead of intraday moves. That's my quick answer.
Cool. Okay.
Absolutely. Especially today, is going to be a very important close, I think. Absolutely.
And if I may say one more thing about the numbers today, I agree 100% that the payrolls number today is arguably a lot more important than it used to be, because employment is the last stand, let's say, the last number that's still doing well, they're still printing well, even though we've talked about quality versus quantity of employment, but it's still, the headline numbers are still doing well. So if that starts to turn lower, like ADP we had earlier this week, and this starts to constitute a trend, then that's going to give central banks and the Fed basically a lot more reason to stop earlier and to potentially cut near the end of the year. But that's, as I said before, it's a different story. You know, this is far enough in the future for me not to really try to fight or care about.
Unless it's a bad number that's weather related, and then it's cat among the pigeons time. Kay, do you want to have a little look around, little update people on the
Yeah.
I don't know if you've got any updates as well, Stel, you want to show?
Not really. No.
Save for next week. It's all going quiet next week.
I'm having some trouble with my charts from yesterday, so I need to.
We'll save them for next week then.
So hopefully Monday I'm going to have a lot more to show.
Okay.
Actually, not hopefully. Certainly. No, Monday I'm in London. Damn. I'm not going to be on the webinars next week. Sorry.
I think Stel's next update will be after the CPI. Once we've digested absolutely everything.
Yeah. Well, let's over to you then, Kay. And just as you're setting up, I've just put a link in there to our non-farm payrolls competition. If you haven't made your guess yet, then please do so. Follow that link, and one of three lucky people will win a free month on our platform. So have a crack at that.
All right. So let's start with the metals, because they were pretty violent yesterday, right? So we went to the top end of this little channel, and a few hours later we were already trading. Today we are already trading on the bottom end of it. So yesterday was a day of how should I call it, exhaustion after the central banks. In any case, if people were short dollars, they decided to take profits, and the metals especially got absolutely hammered. Gold was trading close to 1960, and today we're trading at 1910. This is a pretty big move, right? $50 in gold. It's not your everyday move. Although we've seen moves on the other side, which were pretty violent as well. But yesterday was clearly a day of profit taking, perhaps. And that's only our guess, because I haven't spoken to any interbank traders, but I can imagine that once the central banks were out of the way, some of the bigger boys who had positions on decided to say like, okay, we don't know what the labor report is going to do, we don't know what the ISM is going to do, so let's take a bit of profit, overloading the market as the rest of the market was still trying to sell dollars, and that's what is causing usually those big reversals. Silver tried and failed once more. We tried above 25.50. It even did a runner up to up in the 24.60s. 24. What did I say before? I think I said 25. But 24.60s, and then we saw the same reversal as in gold, and we're already back to the first support. I think I don't know what's going to happen on the numbers today. This thing could actually go all the way back up this afternoon. Why not? If the bigger accounts get what they want to see on this afternoon's NFP. So, but basically, if you look at it and the latest range, it looks like we might be continuing this range for a bit. So watch what's happening around 22.90 today, and again the same levels above 24.50, 60. This red line is starting to water down now a little bit, unfortunately. But I've seen other people trying to cut off the top here and saying that oh no, it's actually not broken yet. But it all depends. I mean, sometimes you make your chart say what you want it to say, right? But anyway, so yeah, still not wanting to break there. But we must say that the 55 DMA has perhaps been playing a little bit as well lately. So, but the big level here is going to be here, right? In the low 22s, that's where the big level is right now. If that gives way, we could go all the way back down to more the bottom end of the channel. But for the time being, personally, I'd be happy to reload a little bit of my the long-term longs that I've been selling out, and I've been very patient now, not being involved at all in all of this trading. Around here, I'd like to start to load some up again, just because of what I said earlier, is that signs are that we are indeed moving towards a softer landing than the worst fears may have thought for a while, but still for the time being we're in the gray zone, as we said. Cable, it did go down a little bit early doors. We had this move under 122. People in the room know that I've been in selling it yesterday on the fixing again. I've taken some more off here. Got done on a trailer here through 50. I'm just toying around with really tiny amounts because I don't know what the NFP and the ISM are going to do. So for the time being, my bias is still to sell rallies in this one, but actively managing on any dip that I'm seeing into the data. Get a move back under, and I think the 121.70 and then 121.40, 50. 121.40, 50 is going to be the magic level, I think, on the downside for the end of the week. those numbers this afternoon can really make the dollar move a lot. So we have to look at the stuff a little bit wider, in my opinion. So 121, 40, 50 is going to be for me. First zone 123, figure 15, figure 20. And then, of course, if the dollar really falters, we are going to have to closely monitor what's happening up in the 124s, of course. Euro dollar, well, the fight for 109 is on. The fight for this trend line is on. The fight for the 109.40 is on. Too tough to call right here and now, I'd say. But 109 figure 40, I think that's your mine at least zone of measurement. If we are above on a close, nothing will prevent us to go and have a test to those higher levels. If we close below, then I think the dollar may be in for a bit of recovery, more recovery, and but we will see how we go after the numbers. So, but this to me is my big zone here. Above or below, we'll decide upon a good few things for next week. And the level below here, we've bounced a good few times of this 107.60-70. So this is the one that I'm going to monitor as well, if the dollar regains some strength this afternoon. Dollar yen, I'm a bit lost right now. This Bank of Japan thing, if Nakaza really is not going to run, and if it's Amamiya getting the job, he should be more of a Kuroda style governor. So I'm really in doubt. I'm not doing much in the yen. I thought of buying euro yen, but then it's trading below this 140.5. Yesterday dropped quite well below as well. With yields across the board coming off, and really I'm hesitant, so I'm going to leave this one alone until next week. My favorite measurement, and that's back to euro dollar, to you know what's going on with the euro. We've rejected quite strongly rejected that zone that I was talking about, somewhere in the 145, 140 area, just below the minus 150 BPs. And we've undone after the ECB. This is the Fed move, and then we've undone it all and gone a little bit lower, and that's where explains your euro dollar being back down as well. Keep an eye on what's happening this afternoon. I think the 160 BPs could be the killer if we widen again more. So the lower it goes here, because it's differentials between the EU and the US 2 years. So the lower it goes, the more pressure we should see on the euro dollar downside. The higher this goes, the more the euro dollar could recover. And this one is probably going to tell us what the euro dollar is doing. And then what else? Yeah, people were asking about the euro Noki. I think I still think we're in breaking up territory for as long as we get a close above this, ideally 1087. I'm very tiny long still, but I want to wait until I see all the data this afternoon and see if I press the button, because I think we might go up until up into the 1120s at some stage. Oil, yes, no, sterling yen. Yeah, sterling yen. So sterling yen, we've talked about this 157.5 yesterday, and it's trading around there. It's still looking very fragile. If you look at the way it sells off, it's quite aggressive. I don't have any opinion on the yen, as I just said, but I'm still relatively bearish on sterling. My bias is still for lower sterling, especially on euro sterling. I think we're going to trade 90 in not too far a distance. in the future. So this one here, it's probably a rally seller. Yeah, it's still looking very fragile. If for people who are short, look 158.5. If that starts to break back up, then perhaps we've seen the best of the move in yen or sterling. So then you have to decide which of the two currencies is the driver here. Something else. What else? What else? What else? Any other stuff that people are looking at? Okay. Yeah, so this afternoon, it's been a while since I updated this one, but this afternoon it's all going to be about those prior lows again in the US 10s, and that's going to be your driver for the dollar yen. And then we're hanging around that 340 zone, really traffic zone here. So 10 BPs up, 10 BPs down. I think if we get back above 350, it could do a bit of a runner. If we collapse through 330, sorry. Then be careful for dollar yen, because we could be on our way to lower levels. So as I was saying on the chat, for the yen traders and the Japanese-based yen traders, they are mostly looking at what's happening in the US in the 10 years. As people were talking about Sten Jacobsen, he's more looking at the 5 years. That's his view. But if you look at the short-term euro-dollar, that's more going to be this famous 2-year. That is really a driver. As we can see, overlay the euro-dollar with this 2-year chart, and you will see that it's really very closely knit. And for me, that's it for today, Ryan.
Thanks, mate. Brian, you need to go and have a couple more coffees. You asked about the NFP link. The next post after, I posted a link to the NFP compo. So scroll up, mate. Look at my link. It's right there. And go grab yourself a couple of coffees, because you don't want to be in that frame of mind when you're trying to trade it later on. No, I'm done. Yeah, I'm done this week.
It's been a long week, man, and we still have a big number coming up.
2 big numbers coming up.
We have a big drinking session on Tuesday. So
and a big drinking session.
Is it Tuesday? Yeah, Tuesday.
Yeah, Tuesday. So Tuesday might be a bit of a quick show, to say the least. I don't know if we can start it a bit earlier, because logistics dictating that I've got to rush for a train after. I don't know. Stel, you obviously won't be around. Kay, will you be on a train then as well, or?
Well, I've got the train a little later than you guys, but I've booked my ticket, so I will see you both in London as well.
Yeah, and it is an open invite, so anyone who's in the UK, near London, in and around London, want to come and join us. We're meeting up from about 3 o'clock in the city at a place called the Jam Pot. Do you remember the Jam Pot, Stel?
I think I do, yeah.
The old place, Jamaica Wine House.
Yeah, I remember.
Bit of old nostalgia, and we can go on from there if need be. But it's open to anyone. If you want to come and join us from 3 o'clock in the Jam Pot in London, you're more than welcome. Happy to buy you a drink. And until then, I hope you've had a good week. I hope you continue to have a good week. And remember, Friday's pips are beer pips. So if you had a good week, don't blow them all on the final day. Watch the show, pick up the pieces after. Thank you to everyone for coming and supporting us here at the Flow Show. Thank you to Kate and Stel, as always. Thank you, guys.
Awesome. Thank you, everybody.
Really,
and have a great weekend, everybody.